Hello and welcome to the edition of Let's Talk Finances. I'm your host, Tay Chayathibong, and today we have a very special guest. We have David Grossman.
Tay, how are you? Good to be here.
Thank you. Welcome and thank you so much for joining us today. Today is a very special day. This is my very first episode. So I'm excited, and I know our viewers are dying to find out what it is about mortgages, especially with today's trends.
Well, I'm happy to help. So should we start with talking about trends?
You know what? Before we get started,
Yes.
I would love to know more about you and how you got into the world of mortgages.
Okay, well, I did a business degree in university a few years back, Tay, and then I got into high tech, but I sort of fell into high tech, and I've always been in sales and account management, and eventually decided to go out on my own when I was close to the age of around 40, which is about 14 years ago. Actually, no, I'm not that old. It was I was 38 at the time, so it was 14 years ago, and I wasn't sure what did I want to do that I could do on my own. So I decided on mortgages because I was always pretty good at math. And I was good at sales and talking to people, which is really what you need. You have to have some analytical skills and some ability to market yourself and talk to people, and that's how I ended up in mortgages 14 years ago.
Excellent. So you must have seen a lot in the 14 years of experience. I know I've seen quite a number of changes from the rates to the new rules. So let's get right into it. So there's a lot of new rules. I know when I qualify clients for their mortgages, it's a lot. There's a lot more. There's a lot more regulation.
There is, and it's been becoming increasingly tougher over the years. There was a time a few years back when we could qualify people with really no proof of income. We had lenders where if you had good credit and you had a down payment that was your own, you could get mortgages with as little as 5% down. You know, we weren't quite as aggressive as they were in the United States, where you could get mortgages with zero down. But we had a pretty aggressive liberal landscape as far as lending goes for a long time. And it's been getting increasingly tighter.
Right.
So it's at a point now where, well, it's tighter than it was, and people are starting to get turned away. You know, I think the government wants to cool the real estate market off,
Right.
and they've definitely achieved that so far, and it hasn't even been that long. The new rules kicked in at the beginning of this year, January 2018. It's now March, and we are seeing, lenders continuing to get tighter in terms of their lending rules.
Yeah. Do you think that will have a positive impact on the economy itself, or what do you think?
Well, I mean, you know, in terms of how it's going to affect the economy overall is a very tough question. I mean, I know they wanted to cool down the real estate market because prices, especially in Toronto, were just going higher and higher and higher, and so they wanted to cool things down, which they've done. As far as how it's going to affect the overall economy, I don't think it's going to help the economy for sure. People are not spending as much money. They're not taking as much equity out of I mean, they were treating their homes like bank machines, right? For a period of time, refinancing, taking out more and more money, and spending it, taking on high levels of debt, but that also contributed to the economy, right? So I think they're spending less money now, so it's not going to help the economy.
Right. So what are some of the challenges you think right now that people need to understand in order to buy a home? Because it's a big dream for everybody to be able to buy a home, and even when you buy a home also to be able to do some renovations, because homes do get old, and you know, it's important to keep it up for your own safety and also the look.
Yes, for sure. Well, there are programs that the insurers, CMHC and some of the other insurers have had for a long time. They call them purchase plus improvements, where if you buy a home and it needs work, you can get in with as little as 5% down. You can do some work. You have to put the money out for the work, but then once it's done, you can get reimbursed. So that's a really great program if you're buying an older house that needs some work. In general, though, people should keep their tax filings up to date, file on time. If you have money for the down payment, make sure it's in your own account.
Right.
We have people from time to time, they say, yes, the down payment's their own, and then we say, well, where, show us the bank statements. Well, it's actually in my mother's account or something like that. So, it's important that they get their name on the account. And this is something probably more for first-time buyers. And it's so that they can show that the down payment is their own. Because if we present an application to a lender, the lender wants to know where is the down payment coming from, and we need proof.
Absolutely. Those are very good points. You spoke about first-time home buyers. I'm seeing a lot of my friends, their parents have helped them out with their first purchase, and I'm seeing grandparents are now, thinking more long-term for their grandkids because of how hot the market has been. Do you have any advice for the new home buyers or parents or grandparents that are thinking about adding this to their children, their grandchildren's portfolio, helping them out, that push?
Sure. Well, it's funny you mentioned, parents, grandparents, because the reality is now to buy a home, especially if you want to buy a home in the city of Toronto and you're just starting out, you need help, right? So if you have parents or grandparents living in the city, or not in the city, but somebody who's got equity, a popular trend now is, early gifting, right? So you don't have to wait till you die to help your kids by giving them the equity in your house. There are different types of mortgage products available. The reverse mortgage, for example, where you don't have to have proof of income. As long as you're at least 55 years old,
right.
You can take equity out of your house. You don't even have to make mortgage payments. So it's a really neat product, and it's something that seniors are using to help their kids or grandkids buy that house in Toronto, which they might otherwise not be able to do.
When would you advise someone to do a reverse mortgage? Because, there's a lot of talk of seniors living longer and needing to spend money more on themselves. And, in the financial planning world, we always talk about, you gotta take care of yourself and take that oxygen mask for yourself first before you can help other people. So is there a line that you look at, it could be in your own practice, so that you're not putting somebody in a position where it could hurt them financially? And also I want to help advise other people, other viewers looking at this, what are some things to look for so that you're not overstretched?
Right. Okay, well, that's a very good question. So the reverse mortgage is and I don't mean to be here touting the reverse mortgage. That wasn't my purpose in accepting this the gracious invitation to be on your show today. But since we're talking about it, the reverse mortgage is exactly that. It's a product that was designed for seniors to allow them to stay in their homes longer if they want to, because sometimes they could be feeling stressed, making tax payments, making debt payments, needing money for home repairs, for nursing care. Sometimes one of the people in the couple might need nursing care or need cash to make certain changes to the house so that it's wheelchair accessible or whatever the case. And the reverse mortgage allows seniors to do exactly that. They can pay themselves a monthly amount by drawing equity out of the house tax-free, or they can take out a lump sum if they need it, and they can use it for any purpose. But it's really the initial design, I think, was to help them. If they want to use that money to help a family member, they can, but it's really to help the senior who's comfortable in their environment, not ready to downsize, not ready to go into a retirement home, to help them to continue with the lifestyle that they're comfortable with.
Talking about lifestyle that people are comfortable with, I'm seeing a huge change of outlook. More people being cautious or I'm seeing more of people being aware of not wanting to be house poor. What are your thoughts on that?
Well, house poor is not a good thing. So, people say now, oh my goodness, the new rules, I'm not going to be able to get into a mortgage. And, you might say, well, what do I think of these new rules? And the answer is that we don't make the rules, we adapt to them, right? So it reminds me of a book on marketing called Zag, right? So when people are zigging, you zag. And there's nothing wrong with not owning a house either. And if you do want to get into the market, and you can, so you could also consider renting in the city of Toronto and maybe buying an investment property in a smaller town like Oshawa or St. Catharines, and somewhere where you can afford to for $400,000 or $500,000 and continue to rent in the city of Toronto. So this idea that people have to own a house and oh my God, it's a travesty. I don't agree with that. In fact, if you did own a house, especially let's say a rental property in the city of Toronto, it would unlikely would it ever positive cash flow. So there are good arguments to not want to own real estate, especially investment real estate in the city of Toronto.
Yes. I think a lot of people, they kind of salivate when you talk about investment properties. Speaking of some, there's a lot of my real estate friends, they're really excited but kind of nervous about getting into like the King Hotel condos, Soho. What are your thoughts on that?
Well, I haven't analyzed those from a business point of view, but they are really business ventures. And I can tell you from a lending standpoint, I have seen people have a very difficult time getting mortgages on those types of hotel condos. I've gotten, not so much of late, but in the last couple of years, I would receive many calls from people who were looking for mortgages on those types of hotel condos. And the appraisals would inevitably come in much lower than what the people paid for them. And all the institutions out there, including the alternative institutions who are usually more flexible, they said, no, we've had our fill. We don't want. So I remember one person came to me and he ended up having to pay something like 8% private money. He bought one of these hotel condos. The sale price was over $1 million. The appraisal came in at something like $800,000. So he had to come up with an extra $200,000 in cash that he didn't budget for. And he paid, and the rate was very high.
Right.
So I don't know what the cash flow is like, and if they're debt servicing or not. But at least getting in was very, very tough from a mortgage point of view.
Yeah, absolutely. There's a lot of underwriting that goes into approving individuals and families for a mortgage. I usually like to remind people, if you're thinking about committing to a 5-year mortgage or a 1 year, or whatever that commitment is, think about putting aside that amount of mortgage you're willing to take out, whether it be $1,500 or $5,000. Try putting that away for 6 months and seeing if you can actually live comfortably like that, and then prepare for some emergencies that could happen, right?
Yeah, absolutely. I mean, you want to be cautious about getting into real estate, especially if your monthly costs to carry the property are going to be much higher than what they used to. what you're used to. The lenders used to call it payment shock. If we submitted an application and showed that the monthly rent that they were paying was substantially lower than what they were going to pay, they would deny the application because of payment shock. But especially now in a rising interest rate environment, it's worthwhile considering longer term money. So you could go with a 5-year term rather than a 1 or 2 year term. And also don't over leverage. Just get what you need. Don't feel the need to max out, because you need to consider what would happen if rates do, and that's what all of these rules are about. The lenders are saying, well, what happens in 5 years or in 3 years when your mortgage comes up for renewal? If the rates have gone up by 2 percentage points, would you still be able to afford that? And that's what these new lending rules are all about. So people should be considering that for themselves. There's nothing wrong with being cautious to make sure you're not going to get stuck.
Absolutely. I completely agree. I think that there's a lot of misunderstanding about getting rates really low. I find that some people aren't reading the contracts very carefully, and then they're not prepared for some changes to come. You hear about it. I know of a gentleman, he had to take a job in another province, a really great opportunity there that he wasn't going to miss out on. But the cost to break that mortgage, because he went with a lower rate, really shocked him in the end. It was I think it was 45,000, he said.
Yes.
Yes.
Yeah, I have seen that too, where. And it happens when people are exiting the market altogether, because typically, even if you have a 5-year mortgage, and let's say after the 3rd year you want to move to another property, you can usually port the mortgage or move the contract to the new property, whether you're going to require a smaller or a larger mortgage. You can usually move it. But if you're going to be exiting the market altogether, sometimes the penalties can be huge. The banks will charge what's called an interest rate differential on fixed rate mortgages. And what that means is that at the time that you break the mortgage, if mortgage rates are lower than they were when you initially contracted, you're going to have to pay a large penalty. Because effectively the bank's saying, well, you're giving us our money back now, and if we're to loan it out, we could only get 3%, but when you contracted, we had you under contract for 4%. So I've also seen penalties in the neighborhood of $25,000 and $30,000. So that's one of the disadvantages of taking a long-term mortgage contract. But if you are buying real estate in another province, some of the lenders are national, so it might be possible to move the contract to another province. Otherwise, you could get hit with a substantial penalty.
Yeah, and nobody wants that.
No, it's not fun. Especially when you don't know about it until you go to close on the sale, and you think you're going to get a certain amount of money from the sale, and then you find out, then your lawyer sends a request to the bank for a payout statement, and all of a sudden you find out that you're getting $30,000 less than you were expecting. That's shocking.
Yeah, and it's not a good shock too.
No.
Yes. So let's talk a bit about shock. What else have you seen that that people need to be more aware of, so they're prepared for these changes? I know, like, I have friends that have bought properties very recently. The mortgage rates were really low, but in 5 years' time, or people that are going to be renewing, there's some of them aren't going to be ready. Of course, they'll have some of the principal paid down, but what are some other shocks do you think people need to prepare for?
Well, listen, anything can happen out there. You never know what could happen with the market. Prices have come down a bit. We've seen people, I've seen this happen a few times recently on new construction, where somebody purchased a house 2 years ago, and now the deal's like almost closing, and they need financing. But the appraiser goes in and says that the house is worth less than what you paid for it. So we're having to get really creative to help people out. Some of these people have a house that they need to sell in order to get the equity out of to close on the new property. And because the market's softer, they're having trouble selling the house as well. So as a result, they're sometimes having to get into alternative mortgages, which are more expensive. They have to also consider second mortgages, maybe getting a second mortgage on their current property if they can't sell it in time to take out some of the equity to close on the new property. So we've seen that happen a fair bit lately as well. And it's important that people move on these things and talk to a professional who can give them guidance early enough. Because if they wait till the last minute, they're going to be scrambling, and in a worst case scenario, you could get sued if you can't close on a property. And the builder could say, look, you've agreed to buy this house for $1.5 million. If I have to sell it in today's market, I might only be able to get, and I only get $1.3 million for it, I can sue you for the $200,000 loss. So it's important that people start planning early, 60 to 90 days before the closing of the property, and talk to an independent mortgage agent, not just the bank, because it's important to get advice from people who have different options available to them.
Yeah. What kind of questions do you think buyers should be asking at this point? Because some people don't know to ask. Like, one of my favorite strategies that I find people don't utilize is laddering a mortgage, because different institutions and brokerages can allow that. Do you want to talk a little bit about laddering and then maybe some strategies you like?
Sure. So when you're saying laddering, are you talking about having multiple?
Yes.
Okay, right. So this is something that's become very popular of late. Basically, the home equity line of credit, let's call it that. And essentially, it's a product where you can have multiple types of mortgages inside one mortgage. So the lending institution might register a charge against the property for $1 million, but they might only advance $500,000 to you on the closing. But you have an opportunity to take more equity out later. So since the charge is registered, as long as you qualify, you could go back and, let's say, get another $100,000 on a line of credit, potentially, or you could have, a 3-year term for part of the mortgage and a 5-year term for part of the mortgage. So it's a good way to diversify as well, so that parts of your mortgage are maturing at different points. So the rates could be higher or lower. It's like a diversification strategy, if you will. There is a downside, though, to having these larger mortgages registered, and that is that if you don't qualify at that bank for the money and you do need additional money, they've kind of blocked you from getting additional money out of your house. There are some workarounds, but they can be costly, because most lenders, if they're thinking about going into second position behind your first mortgage, even though you may have only borrowed $500,000, if the bank has registered $1 million charge against the property, as far as that second mortgage lender goes, they're going behind $1 million mortgage, and if your house is only worth $1 million, you're not going to be able to get any money out of the property. So there is a downside to it as well.
Okay, that's also very good to think about. So can you talk a little bit more about, what you're seeing, what the banks are doing, and then so the pros and cons of the bank, and then also working with a broker that's outside? Because I know going to bank, they're limited to their products, but then you go to broker, you have a little bit more access to multiple lenders.
Yes.
So besides those two, obvious points.
Right. Well, I mean, those are not small points, because I have seen cases, over the years where people we'll talk to somebody at the bank, and depending on the role of that person, sometimes you go into a branch and the person you're speaking to, they could be, handling deposits on one day, and the next minute they're handling investments, and then you come to them and you're asking them for mortgage advice, and they just really may not be qualified. I remember one time a mortgage referral came to me on the fourth day of a purchaser. He had a 5-day financing condition, and he was told by his bank for months. They said, no problem, you
Right.
qualify. You will qualify for this mortgage. Of course, he put in a financing condition anyway, which is something we would always advise to do, just to be on the safe side. But came Monday, he signed the deal on the weekend. The person was on holiday. Tuesday, she was in a meeting. Wednesday, she was waiting for her underwriting department. And finally, Thursday, 5 o'clock at night, they told her that we made a mistake. Well, they didn't admit it, but basically they said, you don't qualify because you're self-employed. You told us you made a certain amount of money, and we assumed that that was the case. Whereas what's important, if you're dealing with somebody, a mortgage professional who is dealing only with mortgages and have seen many cases, has experience dealing with self-employed people, they will clarify. So when you say, I earn $80,000 a year, the person should say, well, are you self-employed or are you not self-employed? Are your tax filings up to date? What are you reporting on your tax returns? Because some people, they might be making $80,000, but after writing off all kinds of expenses, they might be showing $50,000 or even $30,000. Sometimes a person could be earning commission or bonus income, and commission and bonus income is treated differently than salary. So we need to ask enough questions to know, or at least to have a relatively high degree of certainty, what the potential obstacles are going to be, so there's no unwanted surprises.
Absolutely. There's a lot of opportunity out there, and I think if you don't prepare for it, you find out you can't do a lot of the stuff. So planning definitely helps. Working with a professional definitely helps, because you can really guide people to where they really want to go, and then warn them of the risks and the costs associated with the opportunity.
Yeah, well, Tay, I mentioned before that, when I was 38 years old, I had enough of the high-tech business, and so I thought, well, what could I get into? And, it took me a number of years to learn the business, but I'm at a point now where I feel really good about being able to give people advice. It's taken 14 years to get to a point where I can feel really comfortable, advising people, and I enjoy it. So I'm lucky to have that opportunity to help people.
Yes, and I think experience also comes with great wisdom, and it's important to know who you're working with and the years behind them, because it speaks a lot about who you are, how dedicated you are, and how passionate about the industry and what you do. So that's amazing. Did you have any other thoughts or anything that you'd like to share?
Well, one thing I'll just mention is with respect to self-employed people, because that's something that comes up very often. It's a niche that we independent mortgage agents can really help people with, because as I mentioned earlier, self-employed people will often write down their income for tax purposes, and they can get a very difficult time when they go to the banks, because the first thing the banks say is, well, how much are you making? And they want to see your T1 generals and your notice of assessments. Well, we have a group of lenders who specialize in lending to self-employed people, and they really don't care what you're reporting on your T1 generals and notice of assessments. In fact, they don't even want to see them. So as long as you can show that you have a good cash flow, and they want to see what they want to see, besides credit, of course, and some equity, is they want to see that you have good cash flow. That's the most important thing. And if they're satisfied that you have good cash flow, you can get good mortgages today. And the rates may be a little bit higher than the bank, but if you are self-employed and you have the ability to write down your income by writing off legitimate tax expenses, it's a great solution. So self-employed mortgages is a niche that we really enjoy helping people on, especially.
Oh, excellent. What's the time frame that you would say that would be needed to do a proper job to service your clients so that they're not feeling rushed or feeling the pressure to buy? Because some people fall in love with a property and they're like, I would need to buy this right now.
Yeah. Well, it's always good to talk to a mortgage specialist before you start shopping around, so that you know what it's going to look like. Can you afford it? What are you likely to expect? What kind of documents are you going to need to have? And how much time will it take? So, institutions like to have at least a couple of weeks to close a mortgage transaction. So I would say that if it's less than 2 weeks, it's a little bit rushed. We can still arrange mortgages in less than 2 weeks. Sometimes people are in a pinch. We do have private lenders that can help people in those types of situations. But do some planning before you go and you make that offer on a house. Save your time. Save the time of your real estate agent. Talk to a mortgage specialist, and they should hopefully make your life easier.
Absolutely. Thank you. So I have no more questions at this moment, but if you'd like to leave us with some thoughts, I'd love for you to share that.
Well, thanks, Tay. I just want to say that I really appreciate you having me here on the first episode of your great show. I wish you much success. I think you're going to be a fantastic talk show host, and also on your new financial planning venture. I think anyone who comes to you would be very well served, and I hope we can do this again sometime.
Absolutely. It's been a pleasure. Thank you, everyone, for tuning in. I have David Grossman's contact. He's the licensed mortgage agent, so you can check him out on the website that will be coming up right now. Okay? And if you have any questions or anything, you can always shoot us an email or send me a tweet or anything. All the information for my contact is there. Thank you so much for tuning in. Again, thank you, David.
Thank you very much, Tay.
And we'll see you all again.
Good job.
Thank you.
That was awesome.
I wasn't sure to keep going, but I was like, it felt good.
Yeah, no, I think it was perfect.
Yeah?
Yeah,
Okay, you're
yeah.
really good. We had like some rumbling, some
The odd
transformers, but
the
it was
odd
good.
thing, but yeah, that was great. That was fun. Thank
Yeah.
you.
Did you? I didn't know if you wanted me to ask any more questions.
No, I think it was good. Listen, you just kind of dropped the phone, which I think was fine. You had enough stuff in your head, and I thought it went great. So
Okay.
I'm very happy with it. How did you feel about it?
Very calm, I guess, about it. But I think after this, I'll be like, oh, I could have done this. But it's
Well,
good.
we're always learning.
Yeah.
So, but I felt very good about it. I definitely think it was worth the trip downtown.
Excellent.
Yeah.
Glad.
Thank you very much.
Thank you.
Yeah. Okay, awesome.
Thank you, Chris.
Thank you so much, Chris.
That's a wrap. Now for the